The optimal betting, called by many investors as the most important law in finance, called by Buffett the rule number one in investment, and also known as magic formula, and referenced by many other well-known investors like Nassim Taleb, Howard Marks, uh, Mark Spitznagel, and Ray Dalio. They call it's surprisingly that this formula is a little known in to wider audience. It's mostly known in its limited version called as Kelly Criterion and used for optimal bet calculation in gambling. But it's more fundamental than just gambling. It's basically a law that describes how the dynamic system. It's a law describing growth of dynamic system. It could be a biological system like the growth of bacteria, or it could be in finance. It could be growth of your money and your portfolio. And in case of gambling, it's the growth of your money when you gamble at casino or other games. The formula, the article in Wikipedia about the Kelly criterion is, in my opinion, very hard to understand and it's misleading. It's only considered a very narrow case how it could be used um, for optimal bet calculations, and it just gives you some pre-made formula without that's applied only to very narrow case, and it does not explain how this formula arises, where it came from, and it does not consider more complicated cases like how to apply this formula in wider context when the probabilities are not known, for example, the things like that. Okay, that was a prelude, short of explanation what it is, and we're going to now let's look into some calculations and see how it looks like. Okay, we're going to use a simple example um, to better understand what it is, what this optimal betting is, and how it works. And we're going to use a coin game. There's a biased coin with 60% chance of win. There's a biased coin with 60% chance of win. You bet some money, and if you win, your bet is doubled. If you lose, your bet is lost. And you can play many times this game. So the question is, what will be the optimal strategy that will produce you the most money? Say if you play this game 100 times, like what strategy should you choose to get most money and don't get broke? And we're going to answer this question. Additional focus, we're going to answer it intuitively. We're not going to use some formulas. We're just going to use our common sense and some simplistic calculations and some simple calculations. Surprisingly, these simple calculations are called a Monte Carlo simulation, and I personally think it's much easier to understand and much easier to use than the exact formulas like in Wikipedia. But anyway, okay, let's go. So we have our game. As I mentioned, here's the description of the game, and let's run simulation for 100 players playing game 100 times for each player. And if we run it, we will get this this chart. So this is the game step. So it's 5 times. Some player play 5 times, 50 times, 100 times, and this is money each player won. And we don't see much on this chart. Like it's not a very good chart, but I intentionally left it. So this chart shows us that there is something strange going on, like, and there's something strange going on. Okay, let's go deep. Let's limit Let's limit the amount of player to 5 and plot only for 5 players. And here we see a little bit better what's going on. We can see that the players start with $1, and some players want some money. Some players want even $10, but eventually all of them lost money. Let's change the scale to logarithmic to zoom in this area. Basically, the logarithm scale it's better suited for that kind of processes, for the multiplicative processes, and it allows us to better see what's going on. So we switch to logarithmic scale, and now we can see that pretty much all the players steady lose money. Yes, there could be some ups, but eventually all the players go broke. And this is interesting because the game itself is a winning game. We definitely have a 60% chance of win, and we can double our money. So why players lose money? The reason for that is that they overextend or overexpose and bet too much. In all these calculations, we use the same bet of 0.6. So we basically, each time in the game, we bet 60% of our capital. And it's not working well. So basically, if we play this game and bet every time 60% of our capital, we're going to lose all the money. Another strange thing is that if we try to use simplistic classical statistical calculations, like to calculate expected value for our profit, as we do it here, it's going to show us that the game is winning, and like we put $1 and expected value for $1 is that we would have 1.2, but that's not what's going to happen in reality. And the reason, so basically this calculation is wrong. The reason for that is that classical statistics has some conditions. It could be applied only to some. It could be applied only to some situation when there are a couple of conditions are met, and it's called kind of very complicated things like ergodicity, but basically uh, basically this process does not meet one of the conditions required for classical statistics. Uh, so the okay, let's talk it again. Let's explain it again. So classical statistics uses a simplified approach and calculates average over state space. But what we usually we interested in average over time. And in some cases, this simplistic calculation work when the space average are the same as time average. But in most finance, and specifically in this case, it does not work. So if we try to use classical statistics, we're going to get a wrong result. And as in this case, we're going to get the calculation going to show us that we will earn some money, but in reality we will go broke. So what we can use instead? Um, let's plot this the same chart again, but we this time we also going to use a logarithmic scale, and we're also going to plot two more charts. First, we plot this chart, and now we see a little bit better what's going on. We can see lots of kind of paths, and each path is the how each player played 100 times the game. We can see, for example, that for this line, players win some money, some wins and lost. Also, we can see that the vast majority of players are steadily going bankrupt. Like this is the kind of trend. But if we make average. If we use simple statistics and we use average over space or ensemble, it's shown as the mean. So basically, at every step in the game, we calculate the mean, how much money all 100%, how much money 100 players make in total. So this is the mean, average of this total, and we can see that in total the players make money, but in individuals they steadily lose the money. This is interesting situation. As I mentioned, when the interesting case when the classical statistics does not work, and in this case, it's much better to use time average, also known as average growth rate. So instead of measuring the average amount of money for each player, we measure instead the average growth rate. So we measure this. Instead of measuring mean, we measure mean of natural logarithm. And this mean is shown with green line. And it is the correct calculation of what's going on, what's going to happen to us. And as we can see, this mean growth shows us that we're going to, mean growth is below 1, and it's showing us that we're going to go bankrupt. Okay. Okay. There are a couple of other interesting observations for this thing. Okay, let's go on next. So we discovered that if we bet 0.6 60% of our money each time, we're going to lose the game. So what should we do? How we can win this game? How much should we bet each time? And we're going to use a Monte Carlo simulation to answer this question. Basically, what we're doing for every possible bet size, like 1%, like 0%, 1%, 2%, 3%, like 25%, 40%, 60%, and so on. For every individual bet size, we run this simulation and calculate the mean growth ratio. And then we plot it on single chart. And we can see that if, for example, what we used in all the previous calculation, we used a bet size of 60%, and we can see that if we choose this bet size, we're going to lose, because the growth rate will be negative, and we lose the money. Yeah. Also, usually it forms kind of this shape of curve. Usually it's plotted like slightly different. It has this kind of this flat tile because I limited because basically I limited the minimal amount of money by 1 cent. Like you can't go lower than 1 cent. But anyway. So what couple of consequences we can think of looking at this chart? So the first important thing is that we can produce this chart for pretty much any model, for any financial model. Well, I'm using very simple game, like just a coin, tossing a coin. but this approach is more general, and it could be used uh, to analyze more complicated games, more complicated investment models. And we did it without knowing any formulas or any mathematics. Basically, we just use raw power of computer and just brute force all the possible solutions and choose the best one. And it's very, very important and nice nice way, because you don't need to use your brain. Like, you don't need to use to know math to build this. Just let the computer do the hard work, and it will iterate over all the possible millions of possible solutions and find the best for you. So that's basically all the beauty of Monte Carlo simulations. That it kind of may sound a little bit complicated, but in reality it's a huge it's a great advancement in computations, because it does not require much knowledge. You just let the computer do the hard work and enjoy the final result. Okay, if you're interested about how Monte Carlo works, so basically just take a look at these simulations. Maybe I'm going to explain it a bit more in detail in the next video. Let me know in comments if you're interested in this. Okay, couple of more observations about this optimal growth. So what this chart shows us, there are kind of three regions in this chart. The first region, this is the optimal growth ratio. Basically, to win this game and get most money, we need to bet something like 23 or something like 23% of our money every time. And there are three regions in this chart. First, this green region. It's if you use the optimal bet or bets less than optimal. Using bets that less than optimal are safe. You're not going to go broke, but you're going to get slightly less money than you could. There is a yellow area, and for bets slightly larger than optimal bets. Basically, what's going to happen, it does not make sense to use these bets, because you will win less money than you could with betting smaller amount of money, but you also kind of take slightly more risks. So it does not make sense. The yellow dots don't make much sense. And about the red dots, like it's when the average growth ratio is negative, it basically means that you're going to lose the game. So for any bet that's larger than 40%, if you play this game, and you bet 40% of your money or more, you're going to lose. So here's the, if you bet any amount in this range, you're going to lose. Okay, now a couple of practical observations. Yeah, a couple of words about the Warren Buffett mentioned never lose money, never forget rule number one. So basically what he's saying that in growth process, the money loss is very, very bad thing, because it's kind of informal way of saying exactly the same as what this criteria tells formally. Or you can think it like, it doesn't matter how great some of your, even if you have lots and lots of great years when you get like 50% of capital return every year, but if there's just one zero in this sequence of great investments, if one year you go broke, like all your best years are lost. Like, it doesn't matter how how large your growth. If there is just one zero in multiplication, the result will be zero. So even if you just make just one mistake 1 year and allow your capital go to zero, you lost. It doesn't matter how well you did before. And it definitely doesn't matter how you're going to do after that, because you will not have any money to continue. Another couple of consequences is that what we consider here is very simple and clearly defined example, like a coin game. In reality, it's more complicated. When you use this thing, when you calculate, for example, portfolio allocation, optimal portfolio allocation, in reality, you don't know the exact probabilities, and also you usually need to make not just one bet, but multiple bets. You need to play multiple games simultaneously to diversify and for other reasons. Uh, yeah, so the huge problem is that the probabilities are not known, the game mechanics, the game model not known, and you cannot use this approach kind of directly because there is no model. There's no model to simulate from, to use in simulation. Uh, Still, there are ways to deal with that. You can build some approximation based on your understanding of the world and financial assets. You can build, create your own model based on your understanding and use it as an approximation of the kind of real world. Or another simple approaches are fractional Kelly or 1/n. They more okay. I'm not going to go much into these things. It's kind of a separate topic. So basically, it's very important to understand this rule, how it works, why it works this way. It's very beneficial to build a couple of the simulation yourself, just to observe how the capital change over time when you use different strategy, when you use different bet size, that kind of things, to get some intuition of what's going on. But in reality, there are simpler approaches like 1n or fractional Kelly. Okay, that's probably all. I probably should mention a book by Edward Thorpe that's devoted to this rule and explain it in very details. So yeah, if you're interested more, you might check the best thing probably uh, to write some code and do simulation yourself, to observe it firsthand, and also maybe take a look at the Edward Thorpe, the Kelly Criterion book. Also, this report, this page is open, and you can modify the calculation and run it yourself.